Okay, let's touch base with Probal Sen, who's Senior VP as well as Research Analyst at IDFC Securities. Probal, good to have you on the show. What are you expecting from Reliance?
Good morning. Well, I think it's going to be a relatively muted quarter if you really look at it from a quarter-on-quarter perspective. Am I audible?
Please go ahead.
Hello? Yeah, sorry. So I was saying that it's going to be a relatively muted quarter this time around, primarily because the refining margins are obviously in a pretty weak state right now. So even though Reliance is going to do better than most other Indian players, the fact is that the absolute GRMs are likely to come in around the $9 or maybe even below that, which is going to be a 3.5 year low. That pretty much spoils the picture as far as overall earnings are concerned. As far as some of the other segments, I think petrochemical continues to sort of remain flattish. The volume momentum has already sort of played out over the first half of the year, so we don't really expect too much of volume momentum, and margins, particularly in the chemical segment, have been sort of flat to muted. So if one looks at the downstream energy segment, it's going to be relatively muted. What helps them, of course, is that retail and telecom continue to actually do very well. We expect about an 8% QOQ improvement in the retail segment EBIT and a 15% odd EBIT improvement as far as telecom is concerned. That saves the blushes. But on an overall basis, therefore, we would expect that EBITDA would probably be closer to about 205, 206 billion, which is about a 2 to 3% decline QOQ, and net earnings of around 94 odd billion, which again is about 1.3% lower than what they did in Q2. So from that aspect, I think the interesting thing to really look at is how much does the net debt go up by, what has been the capex that is being done in this quarter, and whether we can get any picture of what is happening to the petco gasification project, because that's the next lever of support as far as refining business is concerned.
Right. Probal, what is it that you're hoping to hear in terms of a pricing strategy for Jio? Because it's been a bit of a mixed quarter, while we've seen as to how incumbents have, always caught on to any price cuts by Reliance Jio. When is it that the big boy would say that, okay, from now on, we're going to charge and we are upping our prices for select packages, which has already happened in the past 1 year. But do you think something definitive would come by in terms of a pricing strategy from Jio?
Without trying to be pretentious and trying to step into a telecom analyst shoes, the only thing I can say is the head of the management as far as the telecom business is concerned has always made one point, that we are always going to provide more value for money than that of rivals. We don't really care where the absolute pricing is, as long as our value proposition is the best. Subscriber growth and grabbing market share have continued to be priorities for Reliance, and as of now they have not really shown any inclination, at least in the past few quarters, of moving to a situation where they want to charge more money, or they want to get overall market pricing back up to any levels. So it's very difficult to say when they start to say that, okay, it's time to really start to rationalize pricing a little bit and get it up, because their response always has been that as long as rivals will continue to try and undercut us, our value proposition will continue to be superior, and we are going to match whatever pricing behavior is happening from rivals. So, I think it is something that is there for the overall market to probably do, and by market I mean the major industry players, the likes of Vodafone, Bharti and Jio together. But as of now, looking at the possibility of any concerted policy action from the three looks very difficult, given how heightened the competition is.
On the refining side, there's already that talk about refining margins picking up, but maybe the benchmark Singapore refining margins could be under pressure, and there's not much certainty on whether the uptrend can continue there. Do you think that would be perhaps a headwind?
Yeah, as I said, I think that's been the biggest headwind for this quarter results, and I think even heading into Q4 that remains a primary concern for every downstream energy player. I think refining margins are in situations where we've not really seen in the last 5 to 6 years. I mean, if you look at gasoline spreads, they even went negative at a certain point in Q3, which is not something we've seen in the last decade or so. So it has been a bit of a surprise just how much concerns on global economic growth have been weighing on overall product demand in major consuming nations, and it's very difficult to take a call on when the recovery will happen. We remain optimistic that demand supply trends, if you really look at it, or in the refining space, point to a situation where it remains tightly balanced over the next 2 to 3 years. So as and when some of these concerns get alleviated about just how much of economic growth will the world do as a whole, you're going to see probably product demand coming back. I think what is really weighing on the markets right now, and that's true for crude prices as well as product spreads, is that there are real concerns about a sustained slowdown in global economic growth. And until some signals come through, specifically let's say from China, that those concerns may be unfounded or may not be as bad as people think, I think product spreads could continue to remain a little bit under pressure. What's encouraging, however, for at least for Reliance, is that contrary to what is the weightage for products in the Singapore benchmark, where products like gasoline and naphtha have a much higher weightage, in Indian product slates you have diesel, which is much more prominent, and diesel spreads have not really taken as much of hit as has gasoline in the last 3 months. So on the face of it, while benchmark margins might have declined, maybe a couple of dollars on a quarter-on-quarter basis, we think that the impact on Reliance's margins is going to be less than half of that. So, that is our expectation, and we're going to see what the reported numbers look like.
Right. Probal, just very quickly, a word on the stock price and valuations as well. Assuming that the numbers come in line and along expected lines, do you think there is much scope for a further headroom from the current levels on the stock?
Yeah, I think what we've really seen over the last year is essentially, or maybe over the last 12 to 14 months, is Reliance has just come back to where it used to trade at before the sustained period of underperformance that one saw between 2010 maybe to till 2016. Our sense is that the earnings momentum will only continue to get upgraded. We have seen in the recent 2 to 3 quarters that estimates of retail earnings in particular have been seeing an uptick. Our sense is that as the capex momentum starts to slow down, which remains probably the one concern people have still on the business, that the capex momentum is still stronger than what people thought. As and when that comes down and return ratios really start to show substantial improvement, there's another round of re-rating that I think is still possible. So from here on in, our sense is that there's a very clear 15 to 20% upside that is still there in the stock. Whether that will happen in the next 12 months or 18 months is something that I think will depend on how the capex intensity goes and how much more growth one sees in the telecom and retail businesses, because downstream energy continues to do well. I mean, if you leave aside refining, which is not exactly in their control, every other expansion project that they've done is delivering returns exactly in the way that the company had guided to. So from that aspect, downstream energy remains in very good health. The only question is just how much more upgrades can the telecom and retail business see. And as you mentioned, if there is some action that's taken on pricing, then obviously that will be a huge trigger that one will see over FY20 and 21.
Okay, thanks very much, Probal, for that.